So in this video, we are going to see exchange traded funds. Let's get started. So I would start with some introduction. Stocks. Stock is basically the smallest unit of ownership which an individual can have in a corporation or a company. Bull run and bear run are indicators of the market trend. So if a market sentiment is very positive, and there is a period of sustained optimism, rising prices, and investor confidence in the financial market. It is called a bull run. Bear run is just the opposite of bull run and refers to sustained pessimism and declining economy. So this is declining. So this is bear run. Indexes. So now if we have to see whether it's a bull run or a bear run, the market indexes can be used as a reference point for investors, financial analysts, and policymakers to assess the overall performance of stock market and broader economy. So these are some of the indices which are available: S&P 500 in US, Dow Jones Industrial Average, Nasdaq Composite. In India, BSC and BSC Sensex and Nifty 50 are the two popular indexes. There are some other important market indices which are listed here. I'll not go through them, but they are listed here. You can pause and see them. Now, when we have to take some financial instrument which deals in stock, what are the possibility? There are two possibility: mutual funds and ETF. The difference is ETF is basically traded uh, and they are traded throughout a day like a regular stock. Investors can buy and sell ETF shares at market price during market hours. Mutual funds are typically traded once a day after the market closes. Investors will place order and the transactions are executed at the fund's NAV price at the end of trading day. Okay, so like I said, mutual funds and ETF are both investment vehicles that allow investors to pool their money together to invest in diversified portfolio of securities such as stocks, bonds, or other assets. So it is not only stock; it can be bond or other assets also. And if we talk about index based mutual funds or index based ETF, then they would typically be dealing on what index. And what are the index? The index is what we saw earlier. For example, S&P 500 or in case of India, Nifty 50. So these are the two very popular index based ETFs which are available in the US, the Vanguard S&P 500 ETF and SPDR S&P 500 ETF, also called as SPY. Lastly, I wanted to leave you with this. This is basically the views from Warren Buffett, what he says about the ETFs, index-based ETF. So let's read it. So he says long-term investment. Buffett has repeatedly emphasized the importance of long-term investment horizon. He has recommended that most investors, especially those who are not professional stock pickers, consider investing in low-cost index funds such as those tracking the S&P 500. So index funds, okay, and such as those which are tracking the S&P 500. He believes that holding such index funds over a long term can be a wise strategy for many investors. Now, these have less expense ratio and thereby they are also called low cost investing. Buffett is known for his emphasis on minimizing the investment cost. He has pointed out that the fees and expenses associated with many actively managed funds can eat into returns over time. So what is actively managed? Actively managed is where there is a fund manager and his team. They are daily researching and analyzing, and finally they are purchasing or selling the stocks, and they are managing the fund very actively. In passive strategy, there is an algorithm which would track the market. Basically, if we have to track the S&P, a mathematical algorithm can just track the S&P 500 and no manual intervention is required, or a very little manual intervention is required, thereby reducing the expense ratio. Because the costs are low, so the expenses would also be low. So this is another favorable thing. Third thing is diversification. So Buffett has praised the benefits of diversification for investors. The S&P 500 represents a diversified portfolio of 500 of the largest publicly traded companies in the United States, spanning across various sectors of economy. Predictable returns. So predictable, there is nothing predictable, but predictable is basically the past performance has been uh, commendable in case of index funds. That's what has been told here. Buffett has noted that the S&P 500 has historically delivered solid long-term returns for investors. While the market can experience periods of volatility and downturns, it has generally shown a positive trajectory over a long run. Lastly, conservative investment approach. So this is conservative. So S&P 500 is a reliable option for investors seeking steady market average returns without the need of actively stock picking or speculation. Okay, so there is no need for active stock picking. You can purchase the S&P index fund and keep it for a long term investment. That's the suggestion coming from Buffett also. So with this, I'll leave the video. Thank you very much.